In 2001, one of the most powerful companies in the world collapsed almost overnight. Enron was reporting billions in profits. Its stock was soaring. Investors trusted the numbers. But behind those reports, something dangerous was happening. Debts were hidden, losses were disguised, reality was rewritten. When the truth surfaced, Enron didn't just fail, it imploded. Thousands lost their jobs, investors lost billions, and trust in financial reporting was shaken worldwide. All of it traced back to one failure: unethical financial reporting. This is the Learning Studio, and today we're unpacking financial reporting and disclosure ethics, the difference between numbers that inform and numbers that deceive. Financial reporting isn't just about producing statements, it's about communicating reality. Balance sheets, income statements, cash flows, they aren't paperwork, they're signals. Investors, lenders, employees, and regulators rely on them to decide what to trust, fund, or avoid. That's why ethics matter. The first pillar is transparency. If a company has risks, they must be visible. If it has debt, it must be clear. If profits rely on assumptions, those assumptions must be disclosed. Transparency doesn't mean making the company look perfect. It means making the company understandable. The second pillar is accountability. Management controls the numbers, so management owns the truth. When profits rise, leaders must be able to explain how. When losses appear, they must be acknowledged, not buried. Auditors exist to challenge, verify, and question, not to approve narratives. The most dangerous financial reports aren't the ones with losses, they're the ones that hide them. That's where disclosure ethics come in. Ethical disclosure means sharing information that matters, not just information that looks good. Lawsuits, guarantees, risks, dependencies. If something could influence a decision, it deserves sunlight. This isn't generosity, it's responsibility. After scandals like Enron, the world responded. Stronger rules, tighter oversight, clearer accountability. In the United States, reforms like the Sarbanes-Oxley Act forced executives to personally stand behind their numbers. Globally, consistent reporting standards pushed companies toward clarity instead of creativity. Today, technology can analyze data faster than ever. AI can flag anomalies. Systems can monitor transactions in real time. But here's the uncomfortable truth. Technology can detect problems. Only ethics decides what happens next. Financial reporting without ethics is just storytelling. Ethical reporting is what turns stories into truth. And that's why this topic matters, not just for exams, but for careers, markets, and public trust. In the next video, we'll step into financial markets and institutions, where these reports are judged, traded, and tested every day. Subscribe and continue with the playlist. This is the Learning Studio. I'll see you in the next lesson.